Okay, let's try and unpack this. We're doing a deep dive today into a whole stack of sources you've shared with us.
Yeah, quite a collection.
Definitely. And they seem to paint this picture of global markets feeling a bit, well, unstable, maybe. We've got articles, research notes on everything from government debt, bond market shifts, especially in Japan, to things like currency carries, and even where big money might be looking for opportunity now.
It really is a fascinating mix. You go from the very sort of technical details like Japanese bond auctions,
Right.
all the way through to the fundamental health of major economies like the US and how global money flows are shifting.
Exactly. So our mission here is to try and cut through some of that noise, right? Pull out the key insights from these sources to understand what's really happening behind the headlines.
And why it matters.
And crucially, why it matters to you listening right now. Actually, before we dive in, what were your first thoughts seeing all these pieces together? Just maybe keep that question rattling around as we go through this.
That's a good way to frame it, because these topics, they can feel abstract, but they're real forces impacting budgets, impacting investments.
For sure. So let's start with the immediate market picture. What are the sources telling us about the impact right now?
Well, the big themes jumping out are definitely volatility and uncertainty. No surprise there, perhaps.
Yeah.
But it's interesting how that volatility plays out. Some players are actually doing really well. One source highlights Citadel Securities.
The market maker.
Exactly. Record profits in Q1. They pulled in, $1.7 billion net income from $3.4 billion in trading revenues.
Wow.
Yeah, a 45% jump year over year. One source called it the epitome of good volatility for them. Wider spreads, more trading. They thrive on that kind of choppiness.
Good volatility. That really says something, doesn't it? Bad for some, maybe, but pure opportunity for others.
Precisely.
And speaking of markets jumping around, Japan's bond market is certainly active.
Oh, absolutely. We're seeing yields on Japanese government bonds, JGBs, moving up quite significantly, especially the longer-term ones the sources mentioned, the 20-year, the 40-year.
And demand wasn't great for that 40-year auction recently.
Reportedly the weakest since last July, yeah. Which tells you buyers are demanding higher yields.
But interestingly, one source made a point that, for today at least, these moves in Japan aren't causing massive waves elsewhere. Like, U.S. Treasury yields barely budged.
That's a really key observation in the material, yeah. It suggests the immediate day-to-day contagion isn't perhaps what you might expect right now.
Okay.
But, and this is important, the underlying sense from the sources is that these are symptoms of bigger things brewing. The potential for ripple effects or, contagion down the line, that's definitely there. It feels like pressure building, even if it's contained for the moment.
And meanwhile, the yen itself is getting stronger against the dollar. Good for the yen, maybe, but causes pain elsewhere, which I guess we'll get into.
That's right. It's all connected. So the overall picture, markets are described as choppy or marking time,
Waiting.
sort of digesting things, trying to figure out the next move. European stocks flat, U.S. futures maybe a bit lower. It's a hesitant kind of picture.
Okay, so markets are jittery, Japan's bond yields are rising, but the sky isn't falling globally yet. This brings us to the why. Why now? And why is Japan so central to this story, according to these sources?
Yeah, this is where we really need to connect the dots between the different pieces you sent over. Let's start with the U.S. debt situation, as one source laid it out.
Okay.
It points out U.S. federal debt more than doubled between roughly 2009 and 2024. But for ages, the cost of servicing that debt, the interest expense as a share of the economy, stayed pretty flat.
Because rates were near zero.
Exactly, rock bottom rates. But then, between just 2022 and 2024, as rates started going back up towards more normal levels, that interest expense doubled as a share of GDP.
Doubled. In just 2 years. That's huge.
It's a dramatic jump. And the source says this is creating real budget challenges. It links back to Moody's downgrading U.S. debt recently, citing lawmakers' unwillingness to make difficult fiscal decisions.
Right, that political angle. So the U.S. has this debt pile, and now it's getting much more expensive to carry.
That's the backdrop. Now pivot to Japan. Their public debt is even bigger relative to their economy, under 200% of GDP, one source says.
Wow.
And the Bank of Japan, the BOJ, kept rates nailed to the floor for years, basically 0%.
Right.
But now, your sources point to what one calls a quiet collapse happening inside Japan's bond market. And it's being driven, interestingly, by life insurance companies there.
Insurers, why them?
It's about matching their liabilities. Think about it. They promise annuity payments, policy pullouts, sometimes decades out.
Long-term promises.
Exactly. So they buy huge amounts of long-term Japanese government bonds, JGBs, to match those long-term payouts. It's called managing the duration gap.
Okay, makes sense. Long liabilities, long assets.
It works fine when rates are stable and low. But the problem, highlighted in the sources, is when rates rise. The value of those older long-term bonds with low fixed payments, it just plummets.
Because new bonds offer better returns.
Precisely. And one source uses this great phrase, it leaves the insurers margin wrecked.
Margin wrecked. Ouch. What does that actually mean for them?
It means their assets are suddenly worth much less compared to the liabilities they still owe. This can mess up their capital buffers, trigger regulatory issues. Basically, it forces them to sell those bonds.
Ah, so it's forced selling. Not a strategic choice, but a necessity.
That's the key distinction the sources make. They have to sell to fix their balance sheets, not because they think it's a good time to sell bonds.
And the BOJ finally nudging its main rate up, even just to 0.25%. That was the spark.
Seems to be a major catalyst, yes. After years at zero, even that small hike changes the game. It pressures those bond values and starts unwinding dynamics that have been in place for ages. And this leads us straight into the yen carry trade.
Yes, the carry trade. We hear about it a lot with Japan. Remind us how that works and why the BOJ's move is messing it up.
Okay, so think simple. For years, you could borrow Japanese yen for almost nothing, 0% interest practically.
Free money.
Pretty much. So investors borrow tons of yen, swap it for dollars or euros or whatever, and invest it in places with higher interest rates, US bonds, stocks, global real estate, anything yielding more than zero.
Okay, borrow cheap yen, invest for higher returns elsewhere, pocket the difference.
That's part one. Part two is the currency bet. The whole thing works best if the yen stays weak or gets even weaker against, say, the dollar.
Right, so when you convert your dollar profits back to yen to repay the loan, you get even more yen.
Exactly. You win on the interest rate gap and the currency move.
Oh.
But now, what's happening?
The BOJ hikes rates.
Right. Makes borrowing yen slightly more expensive, but maybe more importantly, it signals a shift, potentially strengthening the yen as money maybe flows back. And at the same time, people are wondering if the US Fed might eventually cut rates.
Which would weaken the dollar.
Correct. So you get this potential pincer movement, as one source called it.
Pincer. Squeezing the trade. Yen borrowing gets pricier, and the yen itself might strengthen against the dollar.
And that strengthening yen is crucial. If you borrowed yen and the yen gets stronger, the value of your debt, measured in dollars, goes up.
Oof.
For investors using lots of leverage, borrowed money to amplify bets, this can trigger margin calls. They need more collateral, where they often have to sell the assets they bought with the borrowed yen.
So, sell U.S. stocks, sell U.S. bonds to cover their rising yen debt. That could be huge.
That's the core risk outlined in the sources, yes. The potential for a wave of forced selling hitting global markets as these carry trades unwind. One source estimates the trade at maybe $600 billion.
Still a lot of money.
It is. But another source paints an even bigger picture. It talks about Asian investors holding maybe $7.5 trillion in U.S. investments, built up over decades of easy, cheap funding in Asia.
$7.5 trillion.
Yeah. And this source uses this really dramatic language, saying the Titanic is finally turning. A fundamental shift away from dollar assets, maybe not for political reasons, but because of the financial mechanics are forcing it. A kind of deep dollarization or even a sell America moment driven by these rate dynamics.
Wow. Titanic turning, sell America, that frames it starkly. Which leads to that question, the sources. Is this unwind a potential financial nuclear bomb? Or is it more like a large but maybe gradual global deleveraging?
And that is precisely the debate we see across the different viewpoints in the material you shared. Where do things actually land?
Okay, so let's get into those different viewpoints. What does this all mean? How severe could it get?
Well, you definitely see a range. Some sources are sounding a clear alarm bell. They're framing this Japanese bond situation and the carry trade unwind as more than just a local issue.
Like a warning shot.
Exactly. A warning shot for global bond markets, or even pointing towards a global debt reckoning. They really focus on the risks of knock-on effects. You know, how forced selling in one area could trigger margin calls and more forced selling elsewhere. A cascade.
But not everyone sees it as Armageddon.
No, others, including some voices from that Reddit source you included, seem Well, less worried about a systemic collapse. Their take is more like, okay, this might blow up some highly leveraged hedge funds.
Ouch for them.
Right. Painful for them, maybe some rich individuals lose money on the carry trade, but they question whether it would really hit the big core banks or major public funds significantly. The key for them is containment. Does it stay in the speculative corners, or does it infect the wider system?
What about specific economies? We talked about U.S. debt, but one expert in the sources sounded fairly confident about the U.S. avoiding the worst.
Yeah, that analysis suggested the U.S. economy could likely skirt recession. Maybe a slowdown, sure, but they pointed to underlying resilience.
That it can ebb and flex.
That was the phrase, yeah. Even with things like tariffs adding some inflation pressure and potentially dragging on growth, the view was the U.S. economy is robust enough to handle it. They even mentioned consumer sentiment holding up surprisingly well, maybe buoyed by the stock market.
Interesting. And Europe. How are their markets taking this compared to Japan or the U.S.?
According to one economist cited, not reacting quite as strongly yet. Maybe different sensitivities, maybe because some markets like UK gilts already have their own big blow up and adjusted somewhat.
Right, they had their own turmoil earlier.
Exactly. But they did note the general global uncertainty, especially around trade, is a risk for European growth and could keep inflation down, which ironically might give the European Central Bank, the ECB, more breathing room to actually cut rates if they feel the need.
So different regions, different responses, different policy levers maybe. Okay, if traditional safe havens like government bonds are looking shaky and currency trades are getting risky, where is money going? What are investors actually doing?
Well, the sources definitely point towards alternatives. There's talk of significant growth in private equity, in infrastructure investing.
Moving away from public markets.
Seems like it. Looking for diversification, looking for yield in places less correlated, perhaps, with the daily swings of stocks and bonds. We saw those comments from KKR, seeing real opportunities in Europe for private capital to fund things like company consolidation, digitization, the energy transition, especially where markets are maybe more fragmented.
And maybe surprisingly to some, Bitcoin came up.
It did get a mention, yeah. One source framed it as a kind of digital gold.
A safe haven.
Potentially is the idea. Gaining acceptance, they argued, partly because of a perceived trust collapse in traditional finance, concerns about massive government debt, the limits of central banks. It's positioned as something outside that traditional system.
Which really brings it all back home, doesn't it? Back to you, listening. How do all these big interconnected shifts, the government debt pressures, the strange things happening in Japanese bonds driven by insurers, the huge carry trade potentially unwinding and forcing sales of global assets, the search for yield in private markets or even crypto. How does that filter down to your financial world, your decisions?
It's a massive question, and the implications are clearly widespread.
So let's recap. We've plunged into some really complex, tangled financial threads today. Huge government debt burdens, the specific deep stress in Japan's bond market.
You're driven by that forced selling from insurers, yeah.
And this potentially enormous unwind of the yen carry trade, which could splash onto asset prices pretty much everywhere.
And we've seen the different takes. Is it a serious warning shot, maybe a debt reckoning, or is it something more contained, mainly hitting speculative players?
We've also touched on how the U.S. and Europe seem to be navigating it differently so far, and how investors are definitely looking beyond the usual suspects towards alternatives like private equity, infrastructure.
And even digital assets, yeah, as maybe the era of super cheap money fades.
It definitely feels like a shift is underway.
These aren't just numbers on a screen. They represent fundamental changes in how money moves and where people see value.
So here's something to think about, maybe mull over after listening today. If a big part of this underlying tension is about unsustainable government debt, and maybe the limits of what central banks can do to keep rates low forever, where do you think trust and real value actually lie in a world adjusting to higher rates and more volatility?
It's a crucial question. We'd genuinely be interested to hear your perspective on that. Based on everything we've discussed from these sources, please do let us know your thoughts.
Thanks for joining us for this deep dive.